Hello, my friends. Today is July 13th, and this is Markets Weekly. So this past week, another exciting week in markets. We had the S&P 500 make new all-time highs. However, on Thursday, though, we did get some volatility. The Nasdaq was down 2%, S&P 500 down 1%. We haven't seen that kind of volatility in some time. Is that the start of the long-awaited correction or merely noise? I have no idea, but looking at price action on Friday, I'm actually becoming less cautious on the equity market. So let's see what happens in the coming weeks. Today, I want to talk about three things. First, this past week was CPI week, and we got some really good CPI data, with CPI printing negative 0.1% month over month, and that is changing the market landscape. Secondly, this past week, it seems like the Ministry of Finance of Japan also intervened in a very well executed currency intervention to strengthen the yen. That seems to have also impacted equity markets. So let's talk a little bit about what the Bank of Japan did and how Japan is potentially rolling out new tools to strengthen the yen. And lastly, so many people have been thinking that the US Treasury is goosing the equity markets by adjusting how they issue debt. This past week, we had Assistant Secretary Joshua Frost, who is actually the person who calls the shots on debt issuance, come out with a lengthy speech detailing how the Treasury issues debt and pushing back against the notion that they are goosing the markets. Let's listen to what he has to say. Okay, starting with inflation data. So this past week, CPI week, the expectations were that CPI would be benign, but it was actually much softer than expected, printing at negative 0.1% month over month, so some slight degree of deflation. Looking under the hood, headline CPI was dragged lower by moderating energy prices, as we see oil has been trending lower, and core CPI was dragged lower by shelter disinflation. Now, the way that the CPI measures shelter is basically on the basis of average rent. We've been seeing for some time over the past couple of years that on the margins, new leases are being signed at very low increases in very low rental increases. So the expectation has always been that eventually this would drag average shelter inflation lower. So many people have been expecting for shelter to disinflate over the past several months, but that just hasn't appeared until seemingly today. So potentially, this may be the beginning of the long-awaited shelter disinflation, but we'll have to see. Those forecasts have been very wrong for some time. In any case, this was a very benign CPI print. This past week, we also got PPI inflation, which is basically inflation for prices paid by businesses. Now, PPI, usually not that important, and it printed a bit higher than expected. The market, though, did not seem to care too much. However, as we all know, what the Fed cares about when it comes to monetary policy is not CPI, it's not PPI, it's PCE, which is a measure of consumer prices. Now, we don't get PCE until later in the month, but when we have all the data we have today, we can make a pretty good estimate as to what PCE will be. The Cleveland Fed has PCE nowcasting web page, and when you look at it, taking into account the CPI, the PPI, and other data, it's actually forecasting PCE month over month to be negative 0.1%. Again, that is a very positive print when it comes to the Fed's efforts to get inflation back towards 2%. The market has been taking into account all this inflation data, and it's changing the landscape. So heading into CPI, the market was thinking that we would get 2 cuts this year. Now the market is thinking maybe we'll get 2.5 cuts. So basically the market is pricing in a more dovish Fed. And that viewpoint is also impacting other markets as well. The dollar weakened notably, and if you look at gold, basically surged. And honestly, it is looking really good. Yields, of course, came down notably this past week, but most interestingly though, was the reaction in the equity markets. Now, if you were to tell me how the equity market would behave If we had a very soft inflation print, I would say obviously equity markets would go to the moon because it's pricing in easier monetary policy. On Thursday, though, the surprise to me was that equity markets actually sold off quite notably in the face of the soft CPI print. And my best guess is that has to do with the reaction in the market to the strengthening Japanese yen, which leads us to our second topic. So it seems like this past week, the Ministry of Finance intervened in the market for another intervention to support the Japanese yen. Now, if you look at the price chart for USD JPY, you notice that over the past couple of years, the yen has been depreciating against the dollar quite notably. No surprise, interest rates in Japan around zero, in the US around 5.5%. So you can have a lot of investors in Japan moving money out of yen into dollars to capture that higher return. The Ministry of Finance in Japan doesn't really want the yen to depreciate uncontrollably, and so it has intervened periodically. A couple years ago, it intervened and strengthened again significantly, sending USD JPY tumbling lower. Then earlier in the year, again, the Japanese authorities intervened again. This time, though, their intervention was much less effective because not too long after the intervention, USD JPY was back pushing against 160 and more recently was around 161. Now, the impact of these currency interventions has been increasingly less effective. The market seems to be becoming increasingly confident that USD JPY just going to the moon. Now, the Ministry of Finance has been telling us that it's not too much worried about the level of the Japanese yen, but more about disorderly depreciation. But it seems like they are actually becoming more worried about the level as well. Now, looking into surveys in Japan, businesses in Japan are thinking that the weak yen, that's not as good as we thought. Maybe it's getting a bit too weak. There are also opinion polls that suggest that the public is becoming unhappy with the depreciating yen, and that's impacting the approval ratings of the current government. So it seems like there's more of a public policy impetus to try to check the depreciation of the yen. So the moment that the CPI print hit Thursday, of course, everyone expects dollar to depreciate with weaker inflation data. But it seems like just at that moment, the Ministry of Finance leapt into action and taking advantage of market moves, again, weakening dollar, just poured gasoline on the fire and exacerbated that move by intervening to the tune of an estimated, say, $20 billion. Not a very big intervention, but because they were pushing right at the time when the market was, USD JPY was on a downward trend in light of the inflation data, got a lot of bang for their buck. And that was, honestly really well timed, really well executed. I'm not sure it was at night in Japan at that time. Were they on standby? Did they know in advance? I don't know, but it was very well executed and did push USD JPY down a few percent. Now, that seems to have actually been negative for the equity markets because looking across the markets, buying USD JPY, so that is to say, buying dollars against yen, has been a very popular trade. In fact, a lot of sophisticated investors who want to buy US assets right now have been funding their dollar assets by borrowing in yen. So if you think about it from their perspective, if you were buying the S&P 500 using yen over the past year, you would have made a lot of money as the S&P 500 appreciated in price, and you would have made a lot of money as the yen depreciated. So it was a double play. Now that trade seems to have been very popular, and as the Ministry of Finance shook that tree a little bit, it seems to have prompted some deleveraging across the board. And so I think that's the reason for that odd price action in US equities. So the question for me right now is just, is the deleveraging done, or do we still have some fragility we need to shake off? On Friday, things seem to rebound a bit. So it seems like there was not that much damage done to those people who had levered trades. And For all I know, and looking what happened in recent months, they just go right back to work, shorting the yen and buying stocks. Now, we all know that Japan can't intervene indefinitely to support the yen because the fundamentals are just so dire for the yen. The interest rate differential is just too wide. Now, the way that the Bank of Japan is thinking about handling that is that it's forecasted to continue to raise rates even as the Fed is cutting rates, and the Bank of Japan may do a bit of quantitative tightening as well. So going into the coming months, that favorable interest rate differential towards the dollar may shrink. Now, just in case that's not enough, it seems like the Japanese authorities are also thinking about adjusting their pension fund allocations to try to strengthen the yen. Let me explain. So over the past few times, as the Japanese authorities have intervened to strengthen the yen, what they've been doing is that they've been taking their foreign reserves, so basically their $1 trillion foreign reserve fund, and selling dollars, buying yen to strengthen the currency. They can't do that indefinitely, though. What they're thinking of doing is that using the giant government pension fund, which has $1.5 trillion in assets and about 40% invested abroad, and trying to take that money and move it back to Japan. So over the past few years, as interest rates in Japan have been very low, the government pension plan has been investing a lot in foreign assets. Again, treasuries, French oats, UK gilts have been much higher yielding than Japanese government bonds, and so it makes sense for the government pension fund to be investing abroad. But now that JGB yields have been going up, and maybe because the yen has been so weak, the government seems to want the pension fund to move some of its money from abroad back home. And that would involve significant amounts of yen purchasing. So the government pension fund sells some, say, treasuries or US stocks, take those dollars, sell them, and buy yen. And that is, over $100 billion in purchases of yen, depending on how quickly they want to do that process. So that portfolio rebalancing process would be a tailwind to come strengthen yen without having the government further exhaust their foreign reserves. So the government has a lot of tools over there to try to strengthen the yen, and if they don't want the yen to weaken any further, they have ways to do that. So personally, I would not be negative on the yen right now. The authorities have told you they don't like what's happening. And the last thing that I want to talk about is how the Treasury goes about issuing debt. So many people have been thinking that the US Treasury is goosing the stock market by issuing more bills than coupons. Let's take a listen.
As you know, the Treasury Borrowing Advisory Committee recommends that T-bills comprise between 15 and 20% of total U.S. debt. Right now, the Treasury is issuing T-bills significantly above that recommended range. Some people, including myself, believe that this is being done to artificially stimulate markets in the run-up to the election.
So that is a sitting U.S. senator basically saying that, the U.S. Treasury goosing the stock market to help Biden. Now, the person who actually decides how debt is issued is Assistant Secretary Josh Frost. Now, many people say it's Yellen. Of course, Yellen is the big boss, but let me tell you, I'm pretty sure that Yellen is not so much into these details and is not well versed in the plumbing. But Josh is. Josh was actually my former boss at the New York Fed, and he had a speech this past week detailing the Treasury's debt issuance process and pushing back against the notion that they are goosing the market. First, he describes just how the Treasury figures out how much debt to issue. Then he goes about how they go about deciding the composition. So the U.S. Treasury first looks at, again, so three things determine how much debt the Treasury has to issue. First, of course, obviously the deficit. When the government spends more than it takes in taxes, it has to finance that spending with debt. Secondly, when there's old debt that's maturing, in practice, it doesn't get paid down. It just gets rolled over. So looking to how much debt the Treasury has to issue the next quarter, you have to take into account the deficit, but also how much debt is maturing, because that maturing debt has to be rolled over. And lastly, the US Treasury also wants to see if there's any changes in how much cash balances it wants to hold. So the Treasury general account right now, say $800 billion, if it wanted to increase that, it would have to issue more debt to finance that. So changes in the TGA also increase overall debt issuance. Now, after you determine how much debt you want to issue, you have to say how are you going to go about financing that? How many bills, how many coupons, what tenors, and so forth. The way the Treasury goes about doing this, of course, first they use bills as a shock absorber. Bills are issued regularly on a weekly basis, but in the event that you have these unforeseen circumstances like COVID, or in the event you have fluctuations in tax receipts, say during April when the Treasury suddenly has a big influx in cash receipts, you would adjust bill issuance to accommodate that. That's your shock absorber. When it comes to coupon issuance, though, the Treasury aims to be regular and predictable. What that means is that every month they'll tell you that we're going to issue output. So they're going to have monthly issuances of all the key benchmark tenors, and they will telegraph in advance just what the sizes are. The Treasury does not issue opportunistically. In the past, they did, but they realized it wasn't very effective. So in the past, maybe they would see, man, interest rates are low in the 10-year sector. I'm just going to go and issue a bunch of 10-year notes. But they don't do that anymore. They realize that basically they're not that good at predicting future interest rate, what interest rates would be in the future. So you could be issuing a bunch of debt when you think interest rates are lower, but it actually goes further lower. Also, when you issue opportunistically, it actually makes things more difficult down the line. So in the past, when the Treasury did issue opportunistically, let's say that interest rate, they thought that longer dated interest rates were low, and so they issued a whole bunch of 10s or 30s. Then eventually one day they're going to have to refinance those 10s and 30s, and that makes things quite lumpy, and it may make it difficult to kind of refinance this big lumpy chunk of debt. So they realized that wasn't a good way of doing this. Over time, what they've come to see is that being regular and predictable is actually the best way for Treasury to minimize their cost of issuance over time, because it increases the liquidity premium of Treasuries. So one thing people will note is that on the run, Treasury debt has a lower yield than off the run. That's a liquidity premium. And having this regular and predictable schedule increases the liquidity premium and makes it actually cheaper for them to issue debt, as it ensures to the market that there will be liquidity in their products. Again, no lumpiness, and also allows investors to prepare for upcoming issuance so that they can digest it better. Now, in the event, though, that the Treasury has to adjust their coupon issuance because of changes in deficits and stuff like that, the way that they would go about doing this to finance higher deficits, well, first and foremost, they would just adjust coupon sizes higher, which is what they've been doing. So let's say that normally they were issuing 50 billion in 2-year notes a month, they could adjust that to 60 billion a month. Secondly, if that wasn't enough, what they could do is they could actually sell debt more frequently. So in the past, they've increased their frequency of tip sales to raise more money. The third thing they could do is that they could increase more tenors for existing products. For example, recently they rolled out a 6-week bill. Again, new product, you're able to raise more money. And lastly, if they still wanted to raise more money, they could come up with new products to appeal to a wider investor base. More recently, of course, floating rate notes, and several years ago, inflation protected securities. So that's how the Treasury goes about doing this. Now, Josh makes it a point, goes out of his way to say, we are definitely not trying to goose the markets by issuing more bills. So he notes that Treasury does have this self-imposed guideline of having bill share be between 50 to 20% of outstanding debt. But he thinks that, this is something that is relatively recent. If you look further back through time, the bill share has actually been much higher. And of course, we're telling everyone that this is temporary. eventually we're going to go back to that 15 to 20% guideline. The decreases in coupon sizes in the recent past, again, fewer coupons, more bills, is just a modest tweak, not a big deal. So that is his explanation as to why the Treasury bill share has been increasing. And he could be totally correct. But again, you have to be aware of the fact that he is a Biden appointee, totally on Team Biden. And so it is in his interest and the interest of his boss to have easier financial conditions, which many people do perceive of higher bill share as doing. In any case, no one knows the truth unless you can read their minds, and it's fair to have both sides of the story. Okay, so that's all I've prepared for today. Thanks so much for tuning in. If you're interested in hearing my thoughts, make sure to check out my blog, fedguy.com. And of course, don't forget to like and subscribe. All right, talk to you guys next week.